Good afternoon, this is Neil Warren, and today I'm considering the issue of VAT challenges for retailers in the post-Covid-19 trading world. I think it's fair to say that many high street retailers will have massive changes when they get back to business full time, and in some cases will take some fairly drastic actions to both survive and prosper. So I'm thinking big in this session, looking at some new income flows for a typical retailer and some changes to their trading plans. So some quite meaty VAT issues involved with this type of strategy. Let's imagine the situation where you've got, for example, a clothes shop that's been trading for many years wholly on its own premises and has decided to adopt a shop-in-shop arrangement with another retail business. Easy example, bring in a retailer that sells shoes to complement the main retail business that sells clothes. Now, when you have a shop-in-shop arrangement, I used to deal with quite a few of these when I was in customs and excise many years ago and dealt with some major retailers, is to look at the VAT liability of the rental income received by the main retailer and also how you account for the VAT and the sales on the takings of the concessionaire. Now, the reason I bring in that second challenge is because in some cases the concessionaire does not have staff or cashiers in the premises, and they rely on the main retailer to both record the takings for them and to manage the cash. So I'll look at the VAT issues of that in a few minutes. When it comes to rental income, the usual question, is there a land supply, or alternatively, is it a right to trade? Now, when it comes to a land supply, the starting point is that rent is VAT exempt, Schedule 9, Group 1 VAT Act 94, and the features of a rental arrangement are a clearly defined area of land for the tenant which he or she can use for their exclusive purposes. Now, if you've got a clearly defined area of land, then that's the starting point, VAT exempt. But if this shop-in-shop arrangement is more flexible, so the second business can float around, have tables and chairs and different areas within the shop, that is a standard rated right to trade. It's not an exempt land supply. Now, for the main retailer, you might think, cool, if we've got exempt income with this arrangement, then it makes sense for us to opt to tax the shop, put VAT on the rent. The concessionaire will be likely VAT registered and claim input tax, and therefore no partial exemption calculations are needed. Now, that's one way of dealing with that particular challenge, but I always come back to the key point with an option to tax decision, and it is a major decision in the world of VAT, is to do it if there's a big input tax incentive. Now, if you haven't got a big input tax incentive, then it's best to not opt to tax, keep the income from renting the building or in the future selling it as VAT exempt in case you get tenants or buyers who can't claim input tax, for example, a dentist, an insurance broker, or a business with sales of financial services. Now, yes, in this situation, opting to tax the building, yes, make the rental income standard rated, you've got rid of the headache of partial exemption, but you've not actually saved a major sum of input tax by doing that. For example, if you bought a building plus VAT to rent out, or major improvement costs, in this particular situation of a typical shop-in-shop arrangement, the input tax will be quite small. And the fact that the input tax will be quite small leads us on to that very useful topic of the partial exemption de minimis limits, where if your exempt income in your business is quite low and your input tax on those costs that relate to the input tax is also quite low, then if the figures are kind, you'll come out as partly exempt de minimis and you'll get the input tax back on your exempt costs anyway. I won't go into that subject any further. I'd need about half an hour to do that. But there's a reference for you, VAT Notice 706, Partial Exemption Notice, Section 11. Second challenge, output tax on the takings of the concessionaire. Who is selling the goods to the customer? So what we've got here is a three-party transaction. And when it comes to three-party deals, it's always important to look at who's supplying who and to whom, or what and to whom. Who is selling the goods to the customers? Now, it could be both outcomes, that the main retailer is selling the goods to the customers, or in fact the concessionaire could be self-accounting of the VAT themselves on their own takings and no involvement in the takings of the business. HMRC is flexible on this scenario, and in the notes I've given you the extract from the manual VRS 8150, and this looks at the issue of whether the reality is that the concessionaire sells goods to the main retailer plus VAT, retailer claims input tax, retailer then does the sales to the final customers, accounts for output tax, or whether in fact the concessionaire organises their own sales with their own cashier, their own tills, etc. Both methods are acceptable. Reason being, of course, is that HMRC are getting output tax either way, so no loss of tax to the revenue. Online trading to increase. I think this is a fairly logical outcome of the Covid-19 crisis, is that there'll be more online shopping and less in the trading premises. Hence why, for example, that previous scenario of shop in shop might be more common in the months and years ahead. A few VAT issues to think about with online trading. Now, those businesses that are already trading online would have considered these issues before, so a useful reminder, but also very important for a new venture trading online. Now, the reality is that with many online sales, there's advance payments by customers. They pay the goods by debit card in advance, receive the goods 5 days or X number of days later. Advance payments of goods where they relate to a specific supply, which is standard rated, creates a tax point for VAT purposes with output tax due at 1/6 of the amount received, assuming they're standard rated. Many retailers, for example, a clothes shop, has both zero rated and standard rated sales, and it's important that anybody involved in the processing of these sales, whether online or in the shop, can recognise the zero rated sales, for example children's clothing for a clothes shop, so that there's no output tax accounted for on those sales. I suppose you could also have zero rated sales if you're selling online if the goods leave the EU, an export sale. We won't go down that line at the moment. Now, one of the most important things with online sales, particularly with items that are likely in many cases to be refunded or returned, like for example clothes, where the customer received the goods and decides they don't fit or other reasons, is to have a very, very clear refunds policy to deal with return goods. And I've seen this go wrong on a number of occasions where retailers reduce their output tax returns but have not got the accounting controls in place so that there's a logical audit trail as to how they reduce the output tax. And this is something that's very important from day one. I read about one clothes retailer, major retailer, that for online sales, almost between 10 and 15% of the sales they make result in return goods. So it's not a small issue for certain retail sectors. Now, when it comes to the VAT requirements for record keeping for any retailer, one of the requirements is to keep a record of daily gross takings. And it's very logical to keep a separate DGT figure for shop sales, record one, and a separate DGT figure for online sales. And then the two totals together form the basis of output tax for the day. There's no need to issue tax invoices to customers who buy goods online unless they specifically request an invoice, i.e. they want to claim input tax themselves if they're VAT registered. A reference there for you, Notice 700, para 16.2.1, to confirm there's no need to issue the invoice. And final point there, making tax digital. Daily gross takings figures are a part of the MTD record, but not each individual sale that makes up the daily total. So no need to go overboard and MTD everything for the online sales. In the notes, I brought in a little bit of an extra quirk to the scenario, a little bit what I call a Brucey bonus, with the website being managed by an overseas business, like, for example, an overseas website designer in India, just to show how the reverse charge needs to be carried out on the VAT return of the retailer to deal with buying services from abroad. I won't go into that any further at this point. The pièce de résistance of my various retail case study scenarios is to look at the situation where we've got a shop, let's say it's ground floor clothes shop, the first floor is used for storage of stock, and the business needs to generate either a capital sum or regular income flow, and the owner decides to convert the first floor storage area into a dwelling, an apartment, to either rent out or sell to maximise the use of that first floor area. And in the notes I've explained how that could be done by having to keep less stock in the business with just-in-time buying techniques. Now, if you start off with a non-residential building, be it an office or a warehouse or a pub, and you convert it into a dwelling, and you sell the dwelling with either a lease exceeding 21 years, 20 in Scotland, or the freehold sale, then it's a zero-rated supply. Many accountants think that you only have a zero-rated supply with a dwelling if you start off with bare land, build a house and sell it. Yes, that is correct. That is zero-rated, but also residential conversions qualify for zero rating as well. VAT Notice 708 Section 5. Now, the great thing is if you have a zero-rated sale, you get your input tax back on your expenses, be it materials or services or professional fees. But very important, when you have a conversion project, it's always important to check that all the conditions of a dwelling are completely met. If you fail a condition of a dwelling, it's no longer a zero-rated sale, and it affects the VAT liability of building work as well. So a reference again for you there, para 14.2 of Notice 708. Now let's think about exempt rental income. This is important. Input tax block, partial exemption again, which we talked about with the shop-in-shop arrangement. But some good news, VAT on building works that involve residential conversions qualify for the 5% rate of VAT, and that lower rate extends to materials supplied by builders as part of their work. So as long as the builder does not apply a 15% plus mark upon the materials, it's better to buy the materials as part of the service from the builder rather than buy the materials separately from a builder's merchant where you'll be charged 20% VAT, which you can't recover if you're renting out. Professional fees always standard rated. Again, I'm thinking here of the current economic climate. I know that we're in different circumstances to 2008 when we had the financial crisis. But again, one thing that might be an issue in the coming years is where dwellings are constructed and with a view to selling them, zero rated, the sales can't be achieved because of a property downturn, and the developer says we'll rent out temporarily to get some rental income, and we'll sell in a couple of years' time when things will hopefully improve. Now, this issue was relevant in 2008, 2009, and HMRC introduced a concession based on a VAT tribunal case where the first supply, which could create a trigger under payback and clawback rules if it's different to what you intended. So if, for example, you claimed all your input tax back on the basis of selling, you then decide to rent out, that's a change of intention. All the VAT you've claimed in the previous 6 years, you have to repay the input tax. However, if the rental intention is temporary, e.g. will rent out for 2 years and then sell, then this concession was brought in 2009 and still can be used, looks at the property over a 10-year life period. So if you rent out for 2 years and then sell, then 8/10 of your 10-year life is a zero-rated sale still. which overrides the general principle that with payback and clawback, you look at the first supply rather than the bigger picture. There's the key reference for you, 706 para 13.12. The end result, hopefully, for smaller developers like our imaginary lady here, Rita, who's just doing the one project, the one flat, is that the input tax you arrive at that's exempt under the 2/10 split in this example is de minimis anyway for partial exemption purposes, and you get it all back anyway. So that is an important issue to be aware of, particularly over the next few years. Okay, so a range of V80 issues there, some meaty stuff, some big decisions taken by the retailer scenarios we've looked at to try and maximise the VAT recovery, to get things right, and to make major decisions that hopefully have long-term good outcomes, like, for example, deciding whether to opt to tax or otherwise. And that concludes this session.